I'm not allowed to tell anybody this private mortgage that you're going to lend on is guaranteed. Do you get in your car and you're like, man, the bank, what a crazy risk takers they are? You don't. You get in your car and you're like, these guys, I wish I was them.
What you could guarantee is that the borrower is tied to their house.
The collateral is powerful and it's easy to sell.
After the entire process played out, the total investor losses so far is zero.
The GIC just can't hold a flame to a solid first mortgage on a residential property at 65% or less. They're making 250% more than the GIC.
Welcome to The Wealthy Lender, episode 12. I'm here with Chris Nichilo, founder of Magnetic Capital Group, Canada's premier private mortgage administration firm. And today we'll talk about how private lending compares to GICs.
That's funny. I think anybody experienced with private lending would be like, compared to GICs.
Yeah, it sounds, knowing what I know, it's a funny comparison.
Yeah, but I think it's important we understand, like, what we're talking about is the safest private mortgage, the lowest priced private mortgage, right? The cheapest private mortgage in the market, which will come with the most security because its loan to value is lower.
Yeah,
we can go.
Here's the idea: up the risk curve, like 7, 8s, 9s, just to.
Yeah, no, but wait, let's define what we're talking about here, because let's talk about the security. What's attractive about a GIC is the G, right? It's a swear word in the investment world, right? Like, I'm not allowed to tell anybody this private mortgage that you're going to lend on is guaranteed. But the government can back that GIC and call it a guaranteed income certificate. And they're allowed. So if I'm trying to sell a private mortgage to an investor over a GIC, and let's also remember that we're talking about the bucket of fixed income assets in your portfolio, fixed income. And for anybody who's not familiar, generally speaking, every investment portfolio has a segment of it that is intended for fixed income. And fixed income is the safest investments you can have. They're consistent, they're predictable, they're safe, right? But the trade-off is that they don't pay very well.
Right.
GICs fit in that category. So do bonds. So do high interest savings accounts. And so do private mortgages, certain kinds of private mortgages. So the question is about the security. So I know that the best GIC I can find right now might be around 4%.
Okay, they're still at 4.
Close to 4. And I know that I could get an incredibly safe first mortgage, private mortgage, at 6%. That's 50% higher than the GIC. So if
Can you break down the safety?
Huh?
Can you break down the safety? How?
Well, this is where I'm headed.
Okay,
yeah,
go ahead.
This is where I'm headed. If you look at the security, so what I'm saying to you is, if we're comparing private mortgage and GIC, let's just say right now, a fair price is 4%. If I tell you that I can get you a private mortgage that's uber safe and it pays 6, well, you have to consider looking at it because it's 50% better return than your GIC. But the natural question that you would be asking is, how much do I lose on the security? Right. So what's the cost of that 50%? So correct. Yeah, sure, it'd be nice that my $1 million now is earning $60,000 a year instead of 40. But how risky is it?
Right.
So now I tell you, okay, I'm going to share with you exactly how risky this is, but you're going to decide. I'm just going to paint a picture for you. So if I came to you and I wanted to borrow $6,500, and I had a piece of pure gold and it was worth $10,000. And let's presume we could go somewhere together and we could have that gold appraised independently. And you have it independently appraised, I have it independently appraised, and the appraisers basically agree. Because one of the nice things about gold is it's universally valued. Wherever you go in the world today, gold is worth what gold is worth. Okay. So now I tell you, you can hold the gold that's worth $10,000 in your safe until I pay you back the $6,500 plus the interest we agree on.
Right.
And if I don't do that within a specific period of time, the gold is yours. So how safe do you feel?
I'm hoping you don't come back.
Yeah. So it's not like that with real estate, but a private mortgage, the property, right? A residential property has the same characteristics as the gold. Number one, it's easy for us both to get the same value, right? To look at it. You have your realtor go, I have my realtor go, or appraisers go, and they agree the value is X. The value is $1 million. Okay. Well, if my house is worth $1 million and I'm asking you to borrow 650, and the rules are that if I don't pay you what I'm supposed to, you get the house. Now, granted, the difference in the real estate market is that if you get the house, you have to sell the house, and you just get you get your 650 plus your interest. You have to give me the rest.
Yeah. It's not
in
a
the gold
profitable
example.
trade.
It's like you walk off with the gold and you go sell it for 9,500. You keep it all. Okay, in that example you do, but in real estate you don't. But that doesn't affect the security. The security is just as good. It's
the safety
excellent.
conversation is the same. Yes.
Safety conversation is the same. So you don't feel like if I said to you okay, better example, you have $1 million house, you go to the bank and you ask to borrow 650 and they go, sure, we'll give you the 650, but you know the rules, right? Like if you don't pay us, we take the house. And you go, yeah, I know, I get it. You walk away. Do you get in your car and you're like, man, the bank, what a crazy risk takers they are. You don't. You get in your car and you're like, these guys, I wish I was them. Like these guys, this is easy money for them. They can't lose. That's how it feels.
Yeah.
So now you look at that, right? And as an investor, you go, okay, well, wait a minute. It's nice that the G stands for guaranteed. Can't deny that. It's nice. I get 4% guaranteed. But in private mortgage, I get what feels like a guarantee. It feels like it's very difficult to lose. And I can tell you with years of experience, 65% loan to value first mortgage, extremely difficult to lose.
What you could guarantee is that the borrower is tied to their house, is emotionally investing in keeping their house.
The collateral is powerful and it's easy to sell. So now you look at it and go, 50% increase on the return. How much am I giving up on the security by being in a private mortgage instead of being in a guaranteed income certificate? For me, I'm not giving up very much. In fact, to your point earlier, I would be okay at 75% of the value of my house. 80%.
What returns are we talking about now?
Okay, now you're talking. Let's just make it easy. Scale up. 65, 6.5. 75, 7.5. 88. Okay, first mortgage. Now you get into second positions and you're at 70%, you're probably at 10. You're at 80%, you're at 11. Right? So I mean, would I feel as good in a private mortgage at 80% of the value as I do in a GIC? No, they're not the same security. There is more risk. But is it 250% more more risk? No way.
If you diversify across multiple deals, I mean,
so if I go 4% and I go to 10%, and I'm at 10%, I'm 70% loan to value in second position behind a first mortgage. Do I feel like I've got 250% more risk than the GIC? Still hard to lose for me. And I'm making 10, I'm making 250% more than the GIC. I'm not suggesting I'm not suggesting that people look at comparing, what should I do? Should I invest in a GIC or a 10% second mortgage? I'm just saying, if you actually look at it, the risk is disproportionate to the increase in return.
And for those wondering, how all this goes sideways, like, okay, well, what is the risk? How can I lose money? We do have another video on the channel explaining that.
Yeah, absolutely. And it's
Yeah.
3 simple things. But the idea here is, let's look at the cheapest private mortgage, the safest private mortgage. Right now, no matter how good you are, if you come to me for a private mortgage, the best you're going to get is probably 6.5%. The very, very best. So 6.5%, that's over 50% more than a GIC. And the security you're going to get is a first mortgage under 65% of the value.
With a high quality borrower.
Yeah. I mean, I would advise my mother to take, at 80 years old, to take the 6.5%. And then you're covering the rate of inflation, right? You're not just preserving your money, but you're actually still building it a bit. Maybe it's kicking off enough for you to have essentially a self-made pension and live off of that, right? You built your nest egg, you got $1 million, but every night you're drawing 65 grand a year. You own your house, you own your car. Maybe you're okay. Maybe it runs alongside your pension. So now you got 65 coming from this and 100 coming from somewhere else or whatever. So yeah, it's really powerful.
Do you want to speak to the other advantage, which is with a GIC, assume like a 1-year term, or I don't know if they call them terms, but you only get your interest back at maturity.
Yeah.
Whereas with a private mortgage, it's monthly payout.
I mean, it is so it's built so brilliantly by the bank because it's a leveraging tool, right? You buy a GIC at 3.5% or 4%. They take that money and they take a spread on it, right? So they lend it to somebody else in the form of a personal line of credit or a credit card or loan of some sort, and they're 6 or 6.5 or 7, right? And so. And they've got it built in that they don't have to pay you the return until they've made a return on your money. So brilliant. We don't do that. But we do pay monthly, right? A private mortgage does pay monthly. So you have that cash flow to work from. But I mean, it's like a high interest savings account. It's no different, right? The high interest savings account is also insured.
Oh yeah, well at that point, what is it, like less than 1? What are they? What are they?
Yeah, I
at
mean,
now?
there's been some that have been as high as 3.
Yeah, okay.
But that's all deposits. That's all banks just trying to get money on deposit because they can borrow against what they have on deposit.
Yeah, but my point with the payouts was, with a GIC, it is strictly like either a wealth preservation / wealth building vehicle. But with a private mortgage, you could actually supplement your lifestyle income.
Oh, true. Yeah, very true. Yeah, that is a big benefit for sure, because that money's coming in every month. Like we talked about, if you put $1 million out, and you're getting 65,000 a year, even 60, you're getting $5,000 a month.
Yeah,
and that's going to help. That's going to help.
All
And
right.
then, one point we should be clear about is that, it's important when you're looking at these types of things to explore the difference on both sides of the equation: return and risk. Risk and return are, in general, positively correlated. And where you're going to find a real winning investment is when you can identify that as return goes up, risk doesn't at the same pace. That's where you're going to find an opportunity. And
Yep,
private
that's the
mortgages do
arbitrage.
that. And private mortgages achieve that because naturally risk and return are positively correlated. One goes up, the other goes up, usually on a very similar track. So if you can find something that doesn't, it's great. In business, for example, the same concept would be that if you can, as revenue goes up, expenses go up. But where you're going to find success is that you can get expenses to stop going up and still do more business and drive more revenue. So
Yeah,
you
yeah.
can leverage. Same concept. So with investing, that's what we're looking for. And private mortgages do a great job of this, right? Because even as returns get into that really high end, the 10, 11s, the 12s, there's a point, in my opinion, when mortgages get where the risk exponentially increases. But before that, there's this lull in risk, this sweet spot right around
Sweet spot. Yeah.
between 6 and 11%, where return is consistently going up and risk is not following. And then all of a sudden, returns up here, risk is down here. But you get past like 12% and it goes like this.
Just hockey sticks upward.
Yeah, the risk just goes up. Why? Because the mortgages aren't sustainable anymore for the borrower. You're actually, by lending somebody money at 12, 13, 14, 15, 16, 18%, you're creating the default. It's almost inevitable, right? So it's just unsustainable for someone to pay those rates year in, year out over time. It just doesn't work. So there's this, like I said, sweet spot where you've got higher returns with lower risk.
Before getting into the space, that's definitely what would have came to mind first, that post 12% risk curve, where it's like, man, why are GICs being brought into the same conversation as private lending? Like, that's just, risky borrowers, risky deals, potential for things to get held out in court, like all this crazy stuff. But like you said, there's a sweet spot that's very easily navigable. Let's not say easy, but simply navigatable if you follow the process, let's say.
Absolutely. Yep.
Yeah.
Yeah. And if you can get in there, right? And again, in my opinion, the sweet spot is 6 to 10, 10 and a half, 11, somewhere in there. Okay. The real sweet spot, though, if you're going to compare it to a GIC, is 6 to 8.
First only.
Yeah, first. Because
Yeah.
6 to 8, if you're comparing to a GIC, right? You don't want to be in second position. There's definitely a gap in risk between a GIC and a second position mortgage. But a first position mortgage to a really well thought through LTV under the right circumstances makes tons of sense and kills a GIC. So there is this really great place that you can exist and not have to be in a GIC.
Yeah.
You can be in something much better and never lose sleep.
Yeah. And like we mentioned before, even though they're much less comparable, the risk is like you said, it's not 250% more risk.
That's right. Now, I want to be really clear because this is just important, and it's not me being arrogant, but I believe this because I'm talking about residential mortgages in Ontario that I wrote. You know what I mean? Like that I underwrote. Because here's what I know: every private lender out there does it their own way. All the power to them. But I only know my way works.
Hey, in this series, we've never brought up the number of mortgages that ended up defaulting and the amount of investor money that was lost.
Well, there's always a few mortgages that default. And it's so important to define what a default is. We have in our business, when we put a status on a file, we have default 1, default 2, and enforcement. Default 1 could be somebody who just missed a payment and within 3 or 4 days they fix it. That's default. It's still a default.
Yeah.
Default 2 is you missed the payment, you ignored the notice, now you're in default, right? Now we're telling you you're in default and you need to fix this within 15 days. But there's no lawyers involved. It's in default. Enforcement is you're not paying attention, I'm not getting through to you. Now there's a legal demand for payment. And if it doesn't come in a certain period of time, we're going to seek possession of the property, right? Take the collateral, liquidate the collateral. There's no emotion in it. It's not where we want to go. It's very rare. We try so hard to avoid, removing people from their homes or any of that, but it can only really happen if somebody is not communicating, not cooperating, not trying to find a solution or working with us collaboratively, yada, yada. So now the other part of your question, how much loss? Oh, okay. And defaults. Okay. So on average, we got close to 100 loans. We probably have 1 or 2 and a lot of months, none missed payments. Almost. So it's very rare. Okay. Then default 2s over the course of a year, a handful that get to default 2. Possession, 1, maybe 2 in a year.
Is there a difference between possession and enforcement?
Possession is a stage in enforcement.
Okay.
So remember, default 1, default 2, then we're into enforcement. We're seeking possession.
Okay. It's the result of enforcement.
Yeah. But all the way through that process, the borrower can redeem the mortgage by just paying it, right? So that's typically what happens. So very few are we in possession of. I think right now we're in possession of 2, maybe 3 properties in the whole portfolio. Okay.
Yeah.
And then losses, 0.
So, like you said, you're not allowed to say the G word. Let's not even say.
Right.
You're not allowed to say the G word, but you're at very few events of default, even fewer level 2 events of default, even fewer, deals that ended up reaching the enforcement stage.
Yeah.
And after the entire process played out, the total investor losses so far is 0.
Yeah, I mean, that's tracking that from 2019 when we switched to residential mortgages, right? So nothing.
Yeah.
Nobody's lost. Now, nobody's lost, I think, primarily because the underwriting is very good, but we do something that not a lot of private lenders do, and that is we are extremely diligent in managing the borrower's experience throughout the entire term, but primarily through the last 3 months. And if they miss a payment. So if they miss a payment or anything happens, we're on the phone with them, we're talking to them, what's going on? It's like catching things early, right? It's like you get sick, but you catch it early, you got a better chance of getting better sooner. So that contributes a lot. And that's something we can talk about in another episode. But no losses, and no losses because we manage well. Not because we're better at it than anybody else. We just manage diligently.
Yep. And it's interesting you say since 2019, because if there was a time to kind of prove that, you can safely manage someone else's money, it's been in the past 6 years.
Oh my God. Yeah, it's funny. You're right. Because we started in 2019, you get COVID right away, right? We're just getting going. We get hit by COVID, and then interest rates go crazy, and now tariffs, and the interest rates are coming right back down. And yeah, it's a depreciating market now. So yeah, I will say it has been pressure tested well, through 6 years. So, it's listen, if you can find here's the closing message. If you can find a good first mortgage at 65% loan to value or less, and you can get 6.5 or better on that, don't do a GIC. Like, don't ever do a GIC if you can find that. And that's what we do. We find those. We create them too. I mean, it's not. They don't compare. A GIC just can't hold a flame to a solid first mortgage on a residential property at 65% or less. I don't think. My opinion.
Not allowed to say guaranteed, but we've laid out the case here.
Yeah, on to the next.
All right. Later, man.
See ya.
Bye bye.